Good afternoon, everyone, and welcome to the second webinar in AFME's 2021 Early Evening Webinar Series on issues related to European high yield and leveraged finance markets. During the first webinar in the series in January, our panelists provided a general update on European leveraged finance markets, but today, in acknowledgement of the central role that issuers and borrowers play in leveraged finance transactions, we will focus on the issuer's perspective. This perspective is important both from a practical standpoint with respect to successful transactions, and importantly, and perhaps increasingly, is very important from a regulatory and policy point of view. Policymakers are making it more and more clear that issuer preferences, and in some cases protections, will be a driving force in many of their regulatory and policy pronouncements and requirements, and therefore it's extremely important that stakeholders engage with issuers and take into account those preferences and interests in this context. For that reason, we thought that it would be helpful to hear directly from issuers today to gain more insight into their motivations and experiences in accessing European leveraged finance markets, and hopefully to try to address any significant issues that they bring to our attention for the betterment of the entire industry. As I said at the beginning of the first webinar in January, 2020 was a solid year for the European high yield market, with issuance volumes slightly higher than 2019, and this in spite of 2020's uncertainty and turbulence. So far, 2021 has started in a robust fashion, with issuances continuing to occur at a high level, which hopefully will continue as we start to come out of the current crisis. These successful issuances, including debut issuances by companies accessing leveraged finance markets for the first time, show that there is a high level of market support for European leveraged finance, and that the European leveraged finance markets can play an important and constructive role in helping to address the financial fallout from the current pandemic. For that reason, I think that even in these trying times, it's important that we continue to find ways to communicate and engage with each other to ensure that the market continues to grow and to run smoothly. Today, we'll hear from CFOs of 3 existing high-yield issuers, each of whom will provide a brief introduction to their businesses, as well as a brief description of their experiences and current status with respect to leveraged finance markets. In addition, a senior leveraged finance banker will share her experiences working with issuers of high-yield bonds and leveraged loans. And towards the end of the webinar, we will provide an opportunity for a Q&A with the panelists. So thanks again for joining us. And with no further interruptions, I'll pass it on to Bernd Bohr from Mayor Brown, who will introduce the panelists and start the program. Bernd.
Thank you very much, Gary. It's a pleasure to team up for this with you again. And it's also great to have another fantastic kind of set of panelists for today. We have Ralf Dihlmann, Chief Financial Officer of the Wepa Group. We have Julia Frank, Senior kind of Director in the Leveraged Finance Origination team at Credit Suisse. We have Robert Johnson, CFO of the Klesch Group, with additional responsibility for Refinery, one of their portfolio companies and existing high-yield issuers. And last but certainly not least, we also have Dr. Volker Metz, Chief Financial Officer of Progroup AG. Maybe kind of just some technical kind of logistic details at the outset. This is a live webinar, so please bear with us in case we encounter any technical difficulties. We'll spend about kind of 40 to 45 minutes on a panel discussion, and then followed by a live Q&A session. And with those technical details out of the way, you can raise your hands or submit questions beforehand, or you can wait towards the end of the session. With that out of the way, let's turn to Wepa Group and Ralf Dihlmann. Ralf, I believe you've prepared a few slides for us. Why don't you tell us a little bit about Wepa Group? Wepa is one of those businesses that most people on this call probably have never heard of, even though most of the people on this call will also have probably used multiple times potentially and possibly even bought kind of Wepa products without knowing. Why don't you tell us a little bit about Wepa and its history and how it's come to the market?
Yeah, thanks, Bernd, for that brief introduction, and welcome to everybody from my side as well. Yeah, let me start with a brief description of our business. As just said, maybe you do not even know us, but you would definitely have used our products already. We are a family-owned company. Wepa is quite 70 years old, and we are producing hygiene paper for the consumers and the public users, consumers business, especially in private label. So you might not have seen our brand actually. Our headquarters is situated in Arnsberg in Germany. We are operating 13 mills all over Europe, in Germany, Italy, France, in the Netherlands, in Poland, and in UK. We are among the largest European tissue paper manufacturers with our 13 mills. When you just, with our 13 mills and our 4,000 employees, we produce around 800,000 tons of hygiene paper each year. By this, we generate a turnover of 1.3 billion euros, meanwhile needing another 1.2 billion in total balance sheet to finance all the machines, as this is a heavy asset-intensive industry. We are number 3 in Europe in tissue production. We understand ourselves as a market leader for sustainable products. This is recycled hygiene paper coming from waste paper, and the hybrid products. This is a mixture of pure pulp and recycled paper. And we are number 1 in private label. So whom do we serve? We do have, on the one hand, the consumer business. Bernd, if you just scroll forward.
Maybe just on those slides, I think it's, of course, very impressive to see kind of all these top positions, but maybe if you could also comment on that it's not just nice to be in the top, but that it's really critical to your business. You're, of course, a bulk commodity business. You're very capital intensive, so size is helpful in terms of kind of realizing kind of large scale capital intensive projects, and also your customers are big customers and they need kind of key suppliers, right? It's not just good enough to be able to supply 1 or 2 or 3 stores. You're kind of supplying your customers. You're essentially supplying hundreds of retail outlets across multiple jurisdictions in many cases.
Yeah, indeed, this is true. So it's about the economies of scale on the one hand, and it's about, let's say, dealing as well with large suppliers and large customers. So we are quite in between. And this was a decision taken 20 years ago, grow or exit. So Wepa decided for grow, and we have now more than 5 times more sales than 20 years ago. And this was as well then a issue we needed to consider in terms of financing. As said, this is a family-owned company, so equity is not that easy to increase. So a debt financing was always necessary, but we will follow up in just a few minutes later.
Yeah, I think you were talking about your 2 main
segments. Coming back to the business, we do have two business units. The one is the consumer business. This is where most of the participants are affected with, where we supply toilet paper, kitchen towels, napkins, hankies, and so on for the retailers that then deliver to the end customers. And we do have a second segment that is the professional business as well. Most of you already were in touch with it, seeing the public spaces with dispensers, having our hand towels in. We as well deliver the dispensers. We have the large industrial rolls or even large toilet paper rolls for a mass business. So we as well deliver systems. It is not only the dispenser and the paper towel, but as well disinfection liquids or anything that is actually necessary and very requested during the COVID wave we all experience. The consumer business is private label business, where we are really specialists in. Meanwhile, the professional business is a branded business where you can find our brand on the dispensers, for example. Yeah.
Maybe just for those on the call that don't, understand the industry, when you talk to private label, if any of you go to a supermarket, one of the big brands, either in the UK, the Benelux, Germany, France, Poland, you'll buy in-store brands, but there is an extremely high likelihood that this will actually be toilet paper, tissues, paper towels produced in one of Wepa's factories, even if the name Wepa will not appear on the packaging.
Yeah, that's correct. And then let's go forward to what is really important for the understanding of Wepa. As we are a family business, we are very keen on all sustainability topics. So we place emphasis on the balance of ecology, economy, and social issues. Social issues, some quite normal from a family business, as we are caring for people. Safety and health measures, very important. Again, coming back to COVID, it proved to be very supportive that we do this very intensively since decades. We have many local engagement at all our sites. And last but not least, we just started an own foundation caring for different topics in hygiene, in sustainability, lifetime learning, and in well-being. Ecology, I've already mentioned it. It's about the reuse of fibers, waste paper. As you know, and you can all imagine, that our paper is normally in end use. You know what you do with it. Normally you flush, so you cannot reuse it anymore. So it's the most sustainable to take already used fibers, as you cannot reuse it anymore. It's as well about energy. We are quite energy intensive as an industry, and we succeeded to drill down our energy consumption by quite 1 percentage point per year since a decade. It's about logistics, it's about packaging. So there's a lot of resources we use, and therefore we care for it since decades, not only for making our life better, it's as well about economy, as this saves a lot of cost. Economy, we understand, as a equality of profit and value orientation. As we are long-term oriented as a family business, we are multi-generational. So our shareholders are very keen on that they exist still in 50 or 100 years. And last but not least, it's about resilience. We are in a very volatile business. We will follow up very soon in coming into the rationales why we have moved into the high yield markets. So
I think you just mentioned that, and I think when we're talking about that size matters in your industry, you mentioned that a little more than 10 years ago the owner family really had to make a decision. It was almost you either grow to become relevant to your very large customers, and also be an important kind of customer for your kind of very large suppliers. So it was either grow or sell almost. And I believe during your tenure, you've really presided over impressive growth. And that was, I believe, one of the drivers why you decided that, accessing the capital markets made sense. And it also creates, I believe, particular challenges from a CFO kind of treasury perspective.
Yeah, absolutely. So growth already started at the year 2000, and there was a doubling of sales within 10 years. And this was classically financed by bank financing, but it became more and more problematic as well in terms of total financing volumes, as we had already increased to more than 250 million euro with a classical consortium of banks. But this increased step by step, so it became more and more problematic. But as well in terms and conditions, about interest rates, about the covenants, the waivers, and whatever was necessary in a volatile business during that times. And this was a decision in 2013 to access the high yield market first time.
And then that also kind of like, I mean, you mentioned a couple of the issues that have, caused kind of the company, the owner family kind of to, look to the high yield market. Kind of there's a number of specific kind of rationales for this. And these are also founded in the fact that you are kind of a family-owned business, kind of have this long-term view, and just wanted to make sure that the financing was aligned, plus the significant capex requirements kind of to drive the expansion.
Yeah, indeed. So to sum it up, there were three key rationales why we have decided to do so. The one is about the requirements from our family business. As said, equity is a scarce source, so it's an ending story within a family. We do have this long-term orientation, so we need a long-term financing. We are asset intensive, so payback periods are in between 5 to 10 years. So this was as well a prerequisite. And last but not least, due to the requirements of the family business, we need some flexibility. We are entrepreneurial driven. We do fast moves. So we need to be able to flexibly finance the business. The second rationale is about this asset intensity. We have this high capital requirements. As I've presented at the very beginning, more than 90% of annual sales is our total balance sheet. So there's a high requirement for any growth we do. And a payback period in any projects in investing into assets is about 5 to 10 years, and that quite perfectly fits into the normal duration that bonds deliver as well, in between 5 to 10 years. So we can perfectly match into our capex programs. And last but not least, it's about this cyclicity of our business. One can really not imagine how cyclical this is, and Volker will follow up later as well. We have quite similar challenges. This is coming from the commodity kind raw materials. This is a global business with pulp, and this has significant fluctuations in quite short periods. We actually just experienced again, and there are some time lags in adapt these prices to our customers. As you can imagine, that a large retailer does not really accept a monthly fluctuation of any raw material prices, as he wants to offer fixed prices to their customers as well. So this is quite a challenge for our businesses, delivers volatilities into our P&L, and therefore we needed a stable financing, and then covenants become quite relevant. And this is one of the major features, you might follow up later, that a bond has a incurrence covenant instead of a maintenance covenant. That makes volatile business much more stable than in classical bank financing.
Thank you. I believe we will revisit kind of both kind of benefits and also challenges in issuing high yield bonds a little later on. But kind of for now, maybe thank you very much. Moving on to Progroup and to Dr. Volker Metz. I believe Progroup is another one of these businesses that most people, unless they kind of live kind of near one of your many plants, have ever heard of. But at the same time, especially now during the lockdown, chances are that the vast majority of the people on this call will have some of your product lying around at home, or have taken delivery of something that was made using your product. And kind of Volker, you've also prepared some slides. Why don't you tell us a little bit about Progroup, what you do, and also kind of why you decided to kind of go to the high yield market.
Okay.
On slide 8.
Yes, thank you, Bernd. Also, good afternoon from. You might see many similarities to Wepa when I present the business of Progroup. We are also a family-owned group, which is probably some would say a hidden champion in his area, We're also headquartered in Germany. We are producing corrugated board, not the corrugated box you may think of or you may have at home at the moment, but the sheet which is the basis for the corrugated boxes. So our end product is still something which needs to be transformed into all kind of packaging, and therefore we focus on this standardized product, which is pure. And also we are backwards integrated in the production of containerboard, the base material for the corrugated sheet. As you can see here on this slide, operating 11 corrugated sheet feeder plants in Europe. We have 2 under the current planning and design phasing. So we are growing organically. This is part of our business, that we are not doing M&A deals, but rather doing organic growth by making one plant after the other. To supply our corrugators, we have 3 paper factories. All of them are located in Germany. They are much bigger than the corrugator, so the idea is to still balance the system in terms of output between corrugated board plants and containerboard. So this 11-3 is a relatively balanced system. We are represented in 6 countries in Central Europe. We think we are number 5 in the recycled containerboard market in Europe, and we are pretty sure that we are number 3 in the corrugated board market. Even if we are not doing the corrugated packaging by our own, this is the part of the business of our customers. Our sales are around 900 million euro. We are only 28 years old, so the company was founded by Jürgen Heindl, our CEO, and has been growing since then organically from 0 to this now almost 900 million euro turnover in 2019. We employ approximately 1,300 people in 2019, and we already grew to more than 1,400 people last year, and we continue to do so in the coming years.
And I believe you brought us a few pictures.
Yeah. I have some pictures to give you an idea what we are talking about. On the left-hand side, you can see one of our latest corrugated board plants in UK. We established this plant in 2018 and started up operations in 2019. And this huge plant, they're currently working at that time, I would say 15 people. This is all we need to run a shift in that plant. And on the right-hand side, you can see one customer. So the huge number of cars, they are the cars of our customers' employees, not the cars of our own employees. So we have a highly automated production. As you can see on the right-hand side, so this is a picture from inside a corrugated board plant. And you can't see any people here. So at the normal operating stage is like you can see on a picture. So there are some people controlling the corrugator, some are unloading trucks, some are loading trucks, but basically it's run automatically. On the next page.
Maybe just like one observation on this slide. I think it's probably coincidence, but both of those plants are not in the Eurozone. Kind of the UK plant, of course, was financed, using sterling. Most costs are in sterling, and I think your customers are all based in the UK. Same for the Tricina plant in Poland. We'll probably get to the challenges that poses from a kind of CFO, kind of treasury perspective. But moving on to the next slide.
On this slide, you can see a picture on our latest paper mill, the PM3 in Germany. We established this plant last year, and we are now in the phase to ramping up this plant. This is huge, even bigger than the corrugated board plant, as you can see here. And this is to give you a rough idea about the capital intensity. We invested roughly 500 million euro in that site. And as you can imagine, for a family-owned business, this is not something you can easily finance through the operating cash flow. So this is also important to have a long-term financing to cover such an investment. On the right-hand picture, you can see. Sure.
I think you'll talk more about your greenfield strategy, but I was fortunate enough to be on the construction side not so long ago, but I think less than 2 years ago, this was literally a green field, right? The picture on the left.
Yeah, it was a cornfield, and now it's only we established this plant within 18 months. This is extremely fast for our industry. So we are really proud that we started up within the time schedule, despite the challenges from the COVID crisis. On the right picture, you can see the internal view on a paper machine. So it's a huge, massive machine with many technical features I can't explain as a CFO, but it's quite complicated, and it's all one big, huge machine. So we can move on to
the picture on the right, I think also kind of, I mean, you had to make the drone fly pretty high to capture the entire site, but to give people an idea of the size, there's some people kind of on the paper machine, and that gives you, I think the paper machine at least is like, as tall as a 4-story building probably, and then the buildings that house the machine are probably at least like 6 stories above ground. So it looked quite small on that aerial picture, but it's a massive factory.
Yeah. On the next page, I would like to say a few words on our strategy. As said before, we are following a pure greenfield strategy, and we are running our business as it was one mill. So the idea is to integrate all sites to one mill system, and to control complexity, we follow a very high level of automation with very limited personnel decisions on the ground floor. Therefore, we are focused on a very high standardization of our processes. And if you want to be successful in such a business, you need to be very productive, have very high production volumes. And therefore, we are focusing on the best available technology and also investing in the best available assets we can get at the time of we set up a new plant. Then let's move to the next slide. Like Wepa, we are also very well aware that sustainability is very important for everyone, and therefore we have been following our green high-tech strategy since the beginning of the company. Our product is 100% recyclable. Therefore, it's very from a sustainability perspective, very good product. You can recycle a fiber several times before it's getting too short. In our own factories, in our paper mills, we use 100% recovered paper as a base material. We are invested in many technologies which are reducing electricity, reducing the consumption of water, but also reducing CO2 emissions through the lower input of natural gas, for example. And at the end of the day, our product can be 100% recyclable. And this as a basis, I would like to move on. What are the financing requirements given these company background? As I said before, we are a family-owned business, and the business itself is very capital intense. And like Wepa, the limitation on equity is the same for us. So we have a high external financing requirement, and these investments have a longer payback period. Therefore, this longer payback period requires also a long-term capital structure. And in our business, we have also a cyclical business part. The containerboard market is cyclical in terms of the margin development. So in some years we have very high margins, in other years it's much less than that. And with a high with the volatility in this part, it's very, very good to have no financial maintenance covenants and a low regular redemptions and a very flexible repayment options. And therefore, financing needs to fulfill these requirements to fit perfectly to the business requirements. We operate in the commodity market, therefore cost leadership is also very essential, and therefore we are looking also for advantageous conditions and also see where public subsidies or grants are available, especially with our best available technologies and energy reducing investments. We have many options in terms of subsidies, but it's also necessary to combine those with the financing structure of the group. And this is also one reason that we are doing the greenfield projects, that we can choose the best available technology, put the capex where we want to have it, not to make compromise on any kind of on any area, and therefore our greenfield approach is one of our big advantages in our business.
At the same time, also a challenge from a financing perspective. I think you just mentioned before, not every project is as big as the PM3 project, but I think you basically had to spend almost €500 million without any kind of immediate kind of EBITDA contribution. So which does have an impact on leverage, and that's something that you need to explain to kind of banks, to investors. I think you've done this multiple times for smaller and larger projects, but on the one hand, key to success, really. On the other hand, a significant challenge.
Exactly. I mean, we are now in a situation we just ramped up the PM3, so we have the full capex in form of debt on our balance sheet, and we have now positive return because we just started up the paper mill. So as the second last point on the right hand side, we have temporary higher peaks in our leverage ratio. This is related to our greenfield approach, and that we are in total a growing business. So we have so many ideas how to continue with the growth path. So also in the future, we will not be a very low leverage company, because we have enough ideas, enough possibilities to further grow the business and make it more profitable. And also, as we are a very integrated group, we do the financing on a group level. So it's also an integrated financing required for the entire group. And then I would like to come to the last page. We decided a couple of years ago that a high yield bond is one of the core components of our financing structure. It has many advantages given our requirements, our financing requirements. As you can see here, large financing volumes are achievable. It's no problem to finance such a paper mill. You can have long maturities. They have regularly a bullet repayment, a very flexible repayment options rather than the regular repayments with a term loan. You have no financial maintenance covenants, and it's also possible to have higher leverage financing, so it's very flexible in terms of the covenant set. Of course, whereas there's also some shadows. There are some disadvantages in this financing. You need an external rating, and given our relatively small size, it's not the easiest way to get an external rating, especially if you compare the public rating with the rating of the banks, and then sometimes you have a disadvantage given this relatively small size. A high yield bond has also a relatively high transaction cost if you compare this with a bilateral loan. If you do it the first time, you might feel that the financing documentation is very complex. It's getting better over time if you do it a second or third time, but for the first time, it's very challenging to go through all the documentation. And if you have a medium-sized financing requirement, it has a limited flexibility. If you look about volumes of 50 to 100 million euro, high yield bond is not in all cases the best instrument. It needs more than, say, 150 to 200 million euro as a minimum size for a new bond. And in our business, it's also one of the disadvantages. We can't include public subsidies through a high yield bond, but of course, there are ways to integrate or to combine high yield bond with other types of financing. And we also included subsidized loans with a high yield in our balance sheet. So this is also possible, but it's not possible to receive public subsidies through a high yield financing itself.
Thank you very much.
From my side.
So yeah, I mean, thank you very much for this already. I think we'll probably touch on more generally on advantages, disadvantages later on. But let's continue in the theme of bulk commodity, capital intensive and cyclical businesses, and maybe move on to Refinery Heide and Robert Johnson. Robert. I think you also brought us a few slides. Most people, you're going to speak for your portfolio company, Refinery Heide. The product is already in the name, or the business in the name. It's a refinery. Most people probably think it's fairly easy. You get a few barrels of crude oil, you light a fire, try to catch the fumes. Should be very easy from a Treasury CFO perspective. But why don't you tell us a little bit about the Heide refinery, for which you are also responsible? And again, I'll put on a slide.
Thanks, Bernd, for the introduction. So I'm actually based in London, and I work for Klesch Group, and Klesch Group owns Refinery Heide. Refinery Heide is based in Germany, in northern Germany. It's about 100 kilometers outside Hamburg. It's situated outside a town called Heide. It's a major business in the region. It employs about 600 people, so it's pretty substantial for that area. And it's a reasonably sized refinery. It processes around 33 million barrels of crude a year. So it's about 100,000 barrels a day of crude that's being processed. The refinery is what we call a high complexity refinery. And I won't go into too many details. That they are quite complex machines. We do have a hydrocracker, which is a piece of machinery which allows us to produce quite a lot of middle distillate products. So we do produce a lot of diesel, heating oil, and jet fuel that is used in aeroplanes. We also produce a lot of gasoline, produce a lot of fuel oil. And again, the high complexity of the refinery lends itself to producing quite a few chemicals as well, which go into the industry in the surrounding region. In terms of major areas of demand, we are the major supplier of fuel oil, of jet oil into the Hamburg airport. We provide 90% of the jet fuel into Hamburg airport. And in terms of the crude that we process, a lot of that comes from the North Sea, but also we do process all of the crude oil production from the Metals oil field, which is just situated off the coast of Germany. In terms of the location and the situation of the asset, the refinery itself is based in Heide, but we also have a significant tank farm, which is based down on the coast, just off the Elbe River, which is the river that flows down into Hamburg. We have significant storage, and we've got 6 million barrels situated across the tank farm down at the Elbe River, plus at Heide, the refinery itself. We have 9 pipelines that flow over 30 kilometers between the tank farm and Heide. They're critical for the supply of the crude into the refinery, and also for the product to flow back to the tank farm and the jetties for export to different markets. We also have a very progressive green agenda. I won't go into too much detail on this now because I know we're going to cover it later. It's a real decarbonisation agenda, and it's driven by a significant investment that we're making in green hydrogen. As I said, I won't go into too much detail on that. I'll come to that later, because I know we're going to have a separate session or section on that. In terms of our financing structure, we have significant working capital financing needs. So we have separate programs for our inventory. We have 3 to 4 million barrels of inventory that we have to finance. We have receivables that we have to finance. So we We have a factoring program for that, 50 to 100 million euros of receivables. And also we're quite a capital intensive business. So we have significant investment that we've made into refinery kit, and that investment is ongoing, of around 600 to 700 million euros of investment in the refinery. Over and above that, and I'll talk about the cyclical nature of the business now, but we don't have an RCF, but we do maintain a significant cash buffer. So we try to maintain around 100 million euros of cash for the volatility associated with the business, which I'll talk about just now. We have a high yield bond. The high yield bond is therefore a structural part of our balance sheet. It's a 250 million high yield bond. It matures at the end of December 22, and it was a 5-year term when it was issued. And it's an important part of our balance sheet and structural part of the way that we fund the business.
Well, one thing that doesn't really show up in your kind of capital structure, but is still very important from a finance perspective, is of course also hedging, right? You're dealing with large amounts of inventory products where the prices, fluctuate intraday, right? And margins also fluctuate wildly within short periods of time. So hedging also really something that is important to you and that needs to work with the overall capital structure.
Absolutely. I mean, the business is cyclical in nature. Refining margins are, we're driven by market prices for our refining margins. So our key income streams are driven by Northwest European product prices and clearly North Sea crude prices. So we do find a lot of volatility in our business, as Bernd quite rightly points out. We have quite an active hedging program in place to help us manage that price volatility, and that hedging program is quite a structured program. It's driven by a risk matrix, and it's a program that allows us to put hedges in place as refining margins become attractive, and we do that in a rateable manner, so that we can lock in higher refining margins and protect both the P&L and the cash volatility associated with the business. In terms of demand is actually quite stable. We run at 85% plus in terms of utilization of the refinery. I think it's the captive nature of the area that we're in, so we have a very stable level of demand in general for the business. It's geographically, I think, quite advantaged. COVID clearly was a challenge in 2020 around demand, and we did see demand levels dropping. I mean, for instance, the jet fuel into Hamburg Airport almost disappeared at one stage, and is only gradually starting to make a comeback now. But clearly, jet fuel has got a long way to go. But overall, the refinery probably dropped down to 75% utilization and still maintained quite a high utilization, again, because of its geography. We do have statutory turnarounds, so it's a major piece of kit, the refinery, and so from a regulatory point of view, we have to do quite regular turnarounds on the kit to maintain it. What that means is that we do get interruptions in our supply and production process. So, for instance, last year we closed half the refinery for a month while we were going through a major turnaround.
Thank you.
Maybe just two other kind of things that we need to deal with in the business. One is foreign exchange. So our business is probably unique in that way, that because we are dealing with oil products, we're dealing with dollar-based oil products, but we're situated in a euro-based country, and so we have a lot of costs in euros, but we have a lot of margin that's based in dollars. So that introduces volatility that we have to deal with. And then finally, flat price. So the price of crude itself, as that price goes up and down, it does impact significantly the amount of funding we need, especially in our working capital. So if you think about, for instance, the amount of inventory that we have in tank at any moment in time, clearly the dollar or euro value of that goes up and down with the flat price of oil as that increases and decreases. So Bernd, I'll stop there for now.
Yeah, and I think it's, takeaways, of course, probably very helpful to not have maintenance covenants given the volatility of the business, and especially also these hopefully short-term kind of on medium-term impacts of shocks like the pandemic. And that's maybe a good segue into kind of our next topic, kind of the benefits, kind of the attraction of, high yield bond or kind of institutional term loans. Maybe kind of Julia, maybe you can tell us a little bit about the the benefits, kind of upsides, kind of the selling points of the public leveraged finance markets. One, of course, kind of good point is that a double B in that market is considered a strong credit, and that high yield means for a strong credit in quotation marks, between 2 and 3% fixed coupon for 7 years. Julia, kind of.
Yeah, indeed. I keep saying we should stop calling it high yield at some point, because really it's just sub-investment grade. But if we look at the state of the markets right now, it's clearly extremely strong. So yields are grinding tighter. And I think it's important. I know there was a separate session on the market as well, but just it's important to remind everyone how strong the markets really are. That's really driven by central bank actions at the moment. So the ECB and the Fed really opened the floodgates, right? They're buying investment grade paper in size, and that directly benefits our markets. So if you think about it, I believe half of the investment grade debt market is trading at a negative yield. In absolute numbers, that's 18 trillion of debt at negative yield. So if you are a fixed income investor and you want to make any sort of return, you dip into the lower ratings categories, right? And that's how this abundant liquidity makes its way into our market as well. Our index currently for across the sub-investment grade space stands at 3.4%, which again, that's why I'm saying it's not really high yield. It finished last year actually at 3.8, so there's almost been a 50 basis points tightening even in the first couple of weeks of this year, just to give you a sense. A double B index that stands at 2.2%. So again, it's very attractive. Single B at 4.6. So clearly no one should feel ashamed or embarrassed or whatever to be a double B or even a single B these days. The market is really there to finance these companies. Also, if you look at the composition of the transactions coming to market, last year was overweight double Bs, but this year we're seeing more and more single B actually come to market. And if you look at what's happening in the US right now, there's actually a big wave of triple Cs coming to market. And usually that's a very good precursor to what might happen here in Europe. So really we'll watch out for that wave as well. It's good to see, though, that investors are really happy and prepared to price risk. COVID has impacted a little bit how they're thinking about their credit analysis, right? To give you an example, whilst usually lots of focus was on leverage, right now investors do appreciate, well, leverage isn't actually that representative, right? Because EBITDA levels of almost every company in the world have been depressed last year, right? So you see actually very elevated leverage levels, but investors are sophisticated enough to really look through that. So they really focus on what measures have you undertaken during the pandemic, for example, maybe streamlining of your cost structure, and how are you coming out of the pandemic, and what's the recovery really from there. So it's very data driven. The other point as well, it's not just companies coming to the market for normal refinancings or capex financings that Ralph and others talked about earlier on, but it's really also rescue financings, right? So in the worst point of the pandemic, some of the worst hit companies in the worst sectors came to market and priced really successful transactions. So just think about airlines, cruises, pub chains, gyms, theme park operators. They've all come to the market, and investors were very happy to actually price this risk and help with liquidity there. So that's really good to see. And obviously now the positive vaccine news helps a lot as well. And as we're seeing more progress towards reopenings, that gives even a further boost to the markets. So yeah, I mean, to cut a long story short, for any like ratings category right now, the markets are extremely supportive. I think some of the issuer panelists have nicely summarized a lot of the benefits that a high yield product brings, and in particular that looking through cyclicality and looking through like difficult periods that might be a more challenging conversation with banks at times is a very attractive feature of bonds, I would say.
So kind of very interesting, attractive commercial reasons kind of why to access either the high yield bond or kind of institutional leveraged loan markets. As a lawyer, I would of course always ask, what are the strings attached? But I think the product also has other really interesting, attractive features to maybe more kind of traditional forms of financing. Kind of, Robert, we talked about the lack of maintenance covenants and how that is really helpful if you're if you're in a cyclical industry to begin with, and potentially at this point also dealing with a once in a lifetime, hopefully, kind of knock on wood, kind of shock situation.
Yeah, absolutely. I mean, our business is cyclical anyway and subject to volatility, and certainly the COVID was an extreme shock in terms of volatility last year. I think if I go back to 2020, I mean, we had a year of lower EBITDA, due to COVID. That put our leverage under pressure. And so I think a high yield bond lends itself to giving us the flexibility to think over the whole cycle rather than having an issue at any point in time, specifically with an issue like COVID. What we tend to do in our business, because of that volatility, is focus on the longer term performance of the business. So for us, the longer term performance is about average profitability over a period of time right through the cycle and the associated cash generation. And then, for us to cope with that volatility in the interim, that's why we have a significant cash buffer, and we put that in place because we know that the business will have situations where there will be certain troughs in terms of performance because of the way the market works. And then over and above that, Bernd, you've already mentioned a hedge program. So we use that hedge program to really try and lock in positive, attractive refining margins. And that helps us both manage our P&L and the associated cash volatility.
Thank you. I think another kind of attractive feature, and I think Volker, kind of, you mentioned this earlier, kind of, especially when you do this for the first time, kind of the covenant package, seems daunting, kind of complex. But with that complexity also comes significant flexibility. You've already shown us kind of slides, kind of this aerial view of PM3, the very large scale kind of investment projects that you managed to kind of to complete without having to go back for waivers, kind of basically flexibility built into the product, especially if you have a very dynamic kind of growth strategy.
Exactly. I mean, back in 2017, at that time, we didn't know exactly when we would build finally the next paper mill. The only thing which was sure that we will build the paper mill within the maturity of the bond. We thought we were emitting at that time, but we included several options to finance this huge project. We built enough flexibility in terms of basket, but also especially dedicated possibilities to finance such a growth project, no matter how the profitability would be at that time when we sign the contract or finally incur the debt. So it was gave us very high flexibility, and there were no limitations in terms of financing this new project. Then in 2018, when we finally decided to go for this expansion project, and at the beginning it's quite complicated to get through all these options, but finally it's very helpful to have these various types of options if you're doing a business like ours with this greenfield approach, a very strong expansion and growth path, and then it fits very good to our business and our business model.
Yeah, I think another kind of key requirement for kind of like the ideal kind of financing, I think it's equally relevant to Progroup or also Wepa is because of the long-term kind of approach of the family owners. I think having and then also the long-term payback horizons for some of these very capital-intensive investments. The having stable long-term anchor funding at the same time with flexibility to repay if and when it makes sense. Ralf, maybe you can tell us a little bit about like how you approached the mix between long-term, short-term, and having that stable element in your capital structure.
Yeah, indeed. So it's an anchor financing, but just agreeing on what Robert and Volker said, it's about this long-term stability, performing strategic targets we want to achieve, and investing through cycles as the business is cyclical. So stability is indeed the biggest asset. However, all the other features, seeing how we have financed our company, are very supportive, as there are different credit facility and permitted liens baskets where you can add different financings to. So quite 2/3 of our total financing of debt financing is the bond. Meanwhile, another 20% is an ABCP program, is an off-balance program that is without any debt covenants, and it's a 50% finance for RCF. For different reasons, the RCF is more the liquidity reserve and maybe some headroom for doing opportunistic steps. As I've said, we are entrepreneurially driven. We are sometimes quite fast in making decisions. So from time to time, we as well use an RCF for a bridge financing into a new bond. And indeed, we approached since 2013 the capital markets 5 times. It was with the original bond in 2013, just directly followed by a tap, and in 2016 a refinancing. In 2019 the next refinancing, stepping up from a 287 million with the very first bond to now actually a 600 million with the last step in 2020. And this indeed is a flexibility that not only pays into improvement of our interest rates. We started with 6.5% and actually being rated with a BB minus. We are at a 2.875. So it just confirms what Julia said. Yeah, it's indeed, one can talk about a yield, maybe not high yield. It's indeed very attractive as well in terms of capital cost. But other flexibilities are as well very supportive, not seeing only the early redemption issues, but as well, for example, dividend baskets, where we are able to take out 50% of our total profits. That gives flexibility to shareholders as well. And last but not least, we can even share some portions of existing liens to the bond that are anyway not on the working capital, but only on the fixed assets. So it's not too restrictive. So the total terms are really supportive to move forward flexibly.
Yeah, I think you mentioned a number of other financing arrangements that you have coexist with the bonds, and I believe like all of your businesses do have other financing arrangements, partly driven by the specific needs of your businesses. I think it's important, of course, to make sure that you don't take away significantly that you've, your hard-fought flexibility under your high-yield bond by entering into, other financings that, cut right through that flexibility. But maybe kind of, Julia, maybe if you could generally kind of talk to us about, like how, like the high-yield bonds, in most cases happily coexist with all sorts of other financing arrangements, and most issuers don't have a like bond-only capital structure, right? There's
Correct.
typically at least like an RCF.
Exactly. So I think, and like, I think Robert, Volker, and Ralph are the best examples, right? So like they all talked about all the various instruments within their financing structure. And indeed, I think I would need to think quite hard to come up with any company that only has a high yield bond in the structure. So yes, it very happily coexists with others. Usually it's some sort of liquidity line, right? But equally, if you can get smaller bilateral facilities that might be attractive for the company, like again, that's not a problem. You can combine a high yield bond with a bank loan, with an institutional loan, et cetera, et cetera. So a bond will always give you the flexibility to incur that debt. Ideally, think about what you require when you issue that bond, right? So we can just make sure that the relevant baskets are in place as well, just to make sure you can incur those operational lines as well.
Yeah, it's a bespoke product, and I believe Robert already mentioned the quite bespoke kind of inventory financing, kind of working capital financing arrangements that coexist with the Heide bond. I think Volker you mentioned that subsidized loans, kind of government subsidized loans are important in your business, especially if you're doing some of these like really kind of cutting edge, state of the art, somewhat experimental kind of environmentally friendly investments, and they're coexisting with Progroup's high yield bonds. But we also mentioned some of the potential flip sides, burdens, and I of course kind of love doing high yield bonds, and I think everybody on this call, everybody on this call kind of is a somewhat of a fan. But Julia, you probably do get encounter reservations kind of, and I think Volker mentioned it's it seems kind of quite expensive and time consuming to do like at least a first time bond.
Yeah, correct. We shouldn't be kidding anyone, right? So it is quite a bit of work, in particular when you do the bond for the first time. So you probably take like 2 months to complete that process. There's various work streams involved, and obviously there's some sort of fixed cost that you have to live with as well, for councils, for rating agencies, for the banks, etc., etc. Obviously, though, if you look at the benefits of the bonds for many companies, it's still totally worth it, right? So it's a painful start, but then you reap the long-term benefits of this financing structure, really. And also, once you've done it for the first time, and you come back for, like Ralph mentioned, he came back to the market so many times, I'm sure he would agree with the statement that the first time was like the most painful, and then it actually gets easier every time you go along, right? So the costs are like lower, and also you then know what you're doing. You only have documents to update. It gets much less painful as you move forward in that process.
Yeah, I think another kind of concern that is sometimes raised kind of when I speak to prospective or actual first-time issues is the concerns around kind of public reporting. Kind of first of all, like the burden, and also is this kind of is more of a necessary evil, or kind of potentially an opportunity to engage with investors, or maybe something in between. I know that all three companies spend quite a significant amount of effort on their kind of investor relations program. So maybe kind of Ralph or Robert, kind of necessary evil, kind of opportunity to engage with investors, kind of maybe kind of just like 1 minute or 30 seconds each. Kind of Robert.
Yeah, I'm happy to start. So investor relations, look, we're well versed at this now. We have a person dedicated to this. And I think it is a lot of initial setup work, but when you get into the run of things, it becomes quite part of the business and relatively easy to do. I mean, we do talk to a lot of our investors. They have a lot of questions about the business, financials, so we do spend a lot of time with them. And we have quite strong interactions with them, and I think we find it beneficial to do it like that. So we have an open door policy from that point of view. As I said, significant effort to set it up, but once you get going, and I think it's part of actually having good discipline in the business. So I think it's helpful.
Mm-hmm. Yeah. Kind of Ralph, do you maybe have thoughts on public reporting?
It's quite same as Robert just said. We do have very positive experience with our investors. Of course, it's time consuming to do regular communication, but it really pays off as investors more and more understand the kind of the business. And we experience that after a time, there is quite a close group that follows the company, understanding us, trusting in us, and especially when we act consistently, this really pays off in high loyalty of our investors. So it's not only burden, it's indeed fun to have them as partners where we can talk to, and seeing the long-term commitment, not only in keeping the bond in some more shaky times, but as well in seeing that a new offering might be signed more than 5 times.
Yeah, I mean, final kind of downside concern, kind of in terms of like the top 3, public rating. Kind of, I know that all of you have very constructive relationships with your rating agencies. Kind of, you need a public rating to access the public markets. There's of course costs, time, expense involved. Sometimes with first-time issuers, I also get concerns, kind of, as long as you're unrated, kind of, you're not putting a label on yourself. Julia mentioned earlier, I keep being sub-investment grade. That's just normal in the market, and double B, that's not junk sub-investment grade. That's a strong credit in that market. But I think I have had situations where kind of issuers were concerned about, how will customers, suppliers respond. What I'm doing to my existing banks to extend their kind of justifying kind of a crossover or investment grade rating, and then suddenly I have that external rating, and there's certain limitations. I don't know, kind of Volker or Ralph, kind of, you have a few words on your thoughts on working with rating agencies as a family-owned, private business.
I mean, of course, as mentioned, it is cost-consuming, especially for the first time, and also it has an ongoing cost component. But I mean, this is part of the overall cost related to it. So if you put it all together, it's still an attractive financing to do a higher bond, even if you consider these additional costs. The concerns regarding suppliers or customers, this was no problem for us. We have got no comments from our customer side or supplier side, so they didn't really care about our ratings. So there was no feedback from this perspective. Of course, they do have discussions sometimes with your banks. They can't ignore the public rating, and sometimes you have discussion with them. On the other side, it's not that they can't that you can't have a higher bank rating than the external rating. So if you perform quite well, it's also possible to have a better rating, bilateral rating from your bank than the public rating, because they just have a different system. So for a medium-sized company, it's much easier to get a better bank rating than a investment grade rating. I mean, you're probably much too small to get in that sphere, but from bilateral rating, of course, they have to look at it, the public rating, but it's not that the banks can't go above that.
Yeah, I think there's like maybe issues with the methodology also. I think you probably strongly believe that it is one of your key strengths, that you're really focused on, one market, kind of one product. From a ratings perspective, it might be better to be more diversified, for example. So certain, like ceiling kind of maybe embedded in the methodology for businesses of your type?
Yes, I mean the rating methodology from a rating agency is more strict. If you have the rating model of a bank, of course they have also rules, but I think the possibilities to adopt it to the company's business model can much easier adopt the bank's rating and reflect the strength of the company. This is more difficult to reflect this in a public rating. So for our business, we are focused on what we are doing, and as you just said, from a rating perspective, they would probably give us a higher score if we would have a higher diversification. For us, we focus on what we can do, what we are good in, and therefore we have to accept that we don't get the highest score in this sub grade or in this criteria for our public rating.
Yeah. Any thoughts on ratings? Maybe kind of Ralph or kind of Robert. Kind of again, I realize that you have very constructive, positive, regular discussions with rating agencies. Robert, you also mentioned like same with like engagement with investors, engaging with rating agencies might also help kind of maybe focus your thinking. Kind of Robert or Ralph, do you have any thoughts?
Yeah, I'm happy just to give. I think the rating agencies, I think, bring a professional edge to the thinking and a professional challenge to the table, and I think it's always helpful to have that outside challenge and to help you with your thinking around the business and the financing of the business. We don't always agree in terms of outlook for the business, but I guess we have different jobs from that point of view. But always respect rating agencies' input, and certainly it's helpful to have the challenge.
Ralph, 30 seconds.
Yeah, I think I only needed 5. It's just confirming that everything the colleagues experienced, we did as well. Maybe being frustrated at the beginning that a investment grade would not be possible. Also, we were investment grade banks, but indeed, it didn't harm us, as you just said. It's relatively a strong credit, and neither our suppliers nor our customers reacted negatively on it. And it's really a constructive work with the agencies. Same with the investors. When you act consistently and you act transparently, they can as well stand some shaky times.
Yeah, we're a little over. I haven't seen any questions, so please, if there's any participants that have questions, raise your hands or submit them via the Q&A function. I think all 3 CFOs, you've all mentioned various kind of ESG initiatives, within your businesses, and also how sustainability is kind of core in sometimes different, sometimes similar ways to your businesses. But maybe kind of Julia, kind of just to, because I do want to mention the ESG point because it's just coming up kind of more and more often. Can you maybe kind of just give us a little bit of an idea of, what I perceive as a rapidly growing importance of general ESG considerations? Kind of, it's not just businesses looking at how to use resources efficiently in the bulk commodity industry, but how investors are also increasingly focused on this and what that means for the leveraged finance market.
Yeah, so it's no, and thank you for bringing this up, because it's really a super important point for all investors at the moment, not just the companies, but obviously I was very pleased to see in all of the 3 presentations ESG being mentioned. So I mean, it's really landing with all market participants. There's really 2 parts to that. First of all, it's very much ESG, not just E. Whilst a lot of people are focused on the E, really the others are also playing a much bigger role these days. If you have a normally structured financing, i.e. not ESG structured, like all of the bonds here, for example, you can still expect a lot of questions from investors on that topic. And that's because they are getting pressure from their own investors, right? So the different fund managers are putting much more emphasis on that topic, just to make sure that any investments are made in good ESG corporate citizens. So if you go and market a bond, there will definitely be questions on these topics, just so investors understand where you stand on it. Now, obviously, the level of questioning is going to be different depending on in what sector you're situated, right? If you're a plastics producer, better be prepared to talk about recycling and circular economy, for example, right? Because that's what investors will want to hear. If you operate hospitals, for example, that might be less of a topic, right? But again, everyone should be on the front foot thinking about these topics. The other trend in the market really is towards the ESG structuring as well. So that's a whole different investor base you can tap if you manage to structure your financing with an ESG angle. So again, that started very much with green bonds a couple of years ago. The limitation there was that you needed a specific use of proceeds that you could be labeling green. And we talked to a lot of companies about it. They were like, I'd love to do this. We think we're a good ESG corporate citizen, but we just don't have that use of proceeds. Now, the market has actually moved on from there. So what we're seeing as the newest developments, it's like, quote unquote, sustainability linked financing. So for example, you can structure your financing to test certain KPIs of ESG on a target, on a specific target date. So, and those KPIs could be anything from CO2 like emissions to women in management, for example. I've seen that as KPIs as well, like really like covering the full ESG spectrum. And basically the effect of missing those KPIs that you set, or the targets, would be an increase in coupon levels. So again, that's a new trend. We haven't seen that much in the sub-investment grade space yet in the bond market. There's been a lot of loans and leverage loans come to market with these features this year so far, and I'm pretty sure we'll see more and more high yield bonds with those features as well.
Maybe like some challenges. I mean, the high yield bond, I think you mentioned flexibility of repayment, the bond being a callable product. How do you deal with, you have a 5-year target, but most bonds get refinanced after 2 years or 3 years. So certain challenges to overcome, but this is certainly cutting edge. And I also really hate to kind of finish it here. I think we could probably spend an hour talking about kind of ESG developments, I mean, sustainable finance. And I also know that, all 3 CFOs have much to say. Kind of, Robert, you had some slides on kind of green hydrogen and how, a refinery can help drive decarbonization of the economy. I think, Volker, you mentioned some of these really cutting edge kind of, closed water cycle, kind of water saving investments, biogas through your wastewater. Kind of Ralph, you mentioned how Wepa has been for decades the leader in hybrid and recycled tissue products. But maybe that's a topic for another webinar. For now, thank you very much to all of you. Thank you also very much to everybody who's kind of joined us to listen in. I hope you're all well and staying safe, you and your families. And we hope to see you, for the next webinar of the series. Thank you very much and goodbye.